Hello guys, welcome to another strategy learning session in Options with Jeet channel. Today we are going to talk about a very popular strategy which is for the neutral view of the market. So the strategy is short straddle. The short straddle, you can see the payoff graph how it looks like. So let me explain what the short straddle is. So this is a sensible interface. Let us see on the left side, we come to the strategy builder and we come to the ready-made strategies and select the neutral positions, and in that you will have the short straddle. Let us click the short straddle and see what Sensible provides us. So what Sensible has provided is at the money PE and at the money CE. If you want to know what is at the money, there is a separate video which I am going to make on the option term glossary. So the option term glossary is what is a option term and what is the meaning of it, and we will see it with a live example. So that video I am still preparing the content, so once it is there I will explain you what it is. So just look forward for that video. So the expiry is 25th of November. So today is 21st of November. Today is a Sunday. So we have 4 days to go for expiry. So the short straddle is, the strategy is a very simple strategy. It is selling a ATM call and selling a ATM put. That's it. Means there is nothing special in that. It is very simple. Sell ATM call, sell ATM put. So this is short straddle. In that process, what we do, we collect a huge premium because the ATM call and ATM put are the only options which has the entire premium as time value. Okay, and that time value is the maximum. All the OTM options, the entire premium is time value. Okay, where you get the maximum time value as premium is on the at the money option. So we collect a huge premium here. The in the money options will have a higher premium, but the thing is the in the money also has intrinsic value. The time value part is there, huge amount is there, but it has also got a intrinsic value. But the at the money option, there is absolutely no intrinsic value or a very little intrinsic value, but most of it is time value. As you know, time value is what we call it as a theta, and the theta is a decaying component. As the time passes, that value will come down. So what we are trying to do is we are going to capture that time value effect and then get our profit in this strategy. Okay, so we are selling a ATM call, we are selling a ATM put. So that is what is a straddle, short straddle. Okay, so by selling this, we are going to collect 250 points. We are selling 17750 P, 17750 CE, and in that process we collect 250 points. Since we did 17750, you reduce the premium points from here, so that is your lower break even. You add your points collected from here is your upper break even. So 17750 minus 250 is 17500. You can see at break even at expiry is 17499, and 17750 plus 250 is 18,000. So that is what you get here. Okay, it's fairly simple. And 250 points collection in Nifty, the contract multiplier is 50, right? So you will get 12,500 and something rupees. Okay, 12,550 rupees. And your break even is exactly at your one standard deviation. That is what is the characteristic of a short straddle, because one standard deviation is calculated on the ATM premiums only. So that is why your break even is there exactly at the one standard deviation. So this is what is a short straddle. So strategy is fairly simple, and for this, since it is a credit strategy, we are collecting credit, our probability of profit is quite high. So it is about 67% of the times we will win here, and your maximum loss is unlimited on the upside. On the downside, it is limited to your the entire Nifty value, because Nifty is 17,750, right? Means if the Nifty goes to zero by expiry, so that much of loss will be there. But for the upside, it is not defined, because Nifty can go 20,000, 25,000 anywhere. There is no ceiling on the upside. The downside ceiling is zero. Okay, Nifty cannot go below zero. Okay, so this one is probably theoretical, so no need to worry about it. Nifty is not going to go to zero in 4 days. Okay, it is highly improbable that Nifty will crash to zero. Okay, it never happened before, and it is not going to happen now. And the funds needed or the margin needed, since we are selling, so the margin needed is a little bit higher. We don't have any hedge here, so we are selling a call and we are selling a put. Both are sell, so we don't have any buy leg. So there is a very minor margin benefit because we have opposing position. So the very minor margin benefit is given, about 25 to 30,000 rupees margin benefit we will get there. So the margin required is little higher, so it is about 1,07,000 rupees. But to enter the trade, we need about 1.2 lakhs. Okay, so this is the summary of a short straddle strategy, means how we will enter. So the main thing is this strategy is an unlimited risk strategy. Up to now, whatever I have given in our channel is a risk defined strategy. So we exactly know what is our risk when we enter the position, and we exactly know what is our profit also. Sometimes profit we keep it undefined, but loss we always try to keep it defined. Okay, because profit let it run, and when it comes to the loss we reduce the loss. So this is what I have been doing. But since I am explaining this strategy, this is quite a popular strategy. So here the loss is undefined. So we have to limit the loss if the position or our view, this is a neutral view strategy. If the market shoots either upside or it crashes downside, we will be in trouble with the strategy, and the strategy will start giving loss. Okay. So to mitigate the loss, what we need to do? Either we need to close the trade, right, and come out with a loss, or we do adjustments to increase our break evens and to come out with a minimum profit or limit our losses. Okay, and since we are doing it in Nifty, if you do it in any indices, you can do it in Bank Nifty, you can do it in Nifty. Bank Nifty, many people will do intraday. Okay, because Bank Nifty positional, since Bank Nifty is very volatile, you have to keep on doing adjustments in that. So positional people are doing, but I don't advise doing a short straddle positional in Bank Nifty. You may disagree with me, but this is what is my view. Your view may be different. I would prefer doing the short straddle strategy in Nifty, which is less volatile, because Bank Nifty can move in the intraday, it can move 1,000 points above, 1,000 points below. Okay. Okay. Now we have seen why we cannot do in Bank Nifty. Let us see whether we can do it in stocks. When you do in stocks the short straddle, many people are doing, but when you are going to do in stocks, at any point of time, one option will be in the money. Okay, and that has a assignment risk at the expiry only, because we are dealing with European options, style options, not American style options. Okay, so what is European style, what is American style? You can refer to the option glossary video which I will be making. Okay, so when I make the video, I will try to provide the link in the description here. So when it comes, you can have a look. You can check the link in the description. If it is there, you can watch that video for the option terms and glossary. Okay, so in the stock, any point of time in a short straddle, one option will be in the money, and you can hold the stock options till expiry. Means you have a assignment risk at expiry, and towards expiry the deep in the money options will have very less liquidity and you will not be able to close, and you need to maintain a physical delivery margin for the stock in the last week of the expiry. If you do it in an index, all these headaches are not there. That is the first advantage of doing it in index. And the stock can open in upper circuit, and since this is a F&O stock, There is no circuit for this. Once the circuit is reached, 15 minutes, the stock will be closed for any trades, then the circuit filter will open. The stock can go up like anything, it can go up like anything. Those disadvantages or those scenarios are not there in the index, because index, the circuit filter is at 10% only. When it reaches 10%, the trading is closed for that day. Okay, means that is what happens in the index. So there is two filters, one is 10, another one is 20. So at 20%, the trading is closed for the day. And the index moving 10 to 20% in a day, it has happened only once. That was when the UPA2 came back to the power. Apart from that, we do not have any instance of the stock or the index or any instances of the index opening gap up by 10 or 20%. Opening gap down 10% is also not there. Even during the corona crash, I think it was maximum 5.5, 6% or up to 8%, not more than that. Okay. In that situation, any strategy you do will be in loss unless until you are on the short side of the market. If you have sold some calls, you would have made profit, or you have bought some puts, you have made profit. Means those situations are exceptional situations. Okay, in a normal situation, a stock opening gap up or gap down by 5 to 10% is more likely than an index opening gap up by 5 to 10% or gap down by 5 to 10%. Okay, so it's clear for you, right? So why I am trying to do it in Nifty only. Nifty is less volatile, first point. It does not have a physical settlement, second point, and it has a very good liquidity even in the ITM options. So that is the third point. These are the advantages of doing the short straddle in Nifty. Let us come to the adjustment part. That is the most important. Since this is a unlimited risk strategy, we have to do adjustments, right? If the trade goes wrong, we cannot like keep the loss and then hope the market to come back and expire within our level. That is not going to happen. Okay, so whenever we are having the break even strikes or break even levels breached, we have to do a adjustment. I will explain you three adjustments which can be done for a short straddle. Okay, the first adjustment for the short straddle is buying either a call or put on the tested side to make the strategy risk defined for that leg only. So this is your first adjustment. Like consider that right now the market is at 17,750 and the market goes down. You have taken this position and the market goes down and then it breaches the 17,500. Okay, when it breaches 17,500, we will start getting the unlimited risk loss. Okay, so when it reaches here, what we need to do is we have to buy one put and then cover the risk on the downside. I am talking about the market crashing down. I will explain the market going up also. Okay, when the market is coming down, so what we do, 17,500, the market has come, right? So what we do, we simply go and buy a 17,400 put, because we sold 17,750 put, right? To hedge that, we will buy a 17,400 put. The premiums will be different. It is showing 24 rupees, but when the market goes down, this premium will be close to 50 rupees, right? You have to consider that. I am going with the current premiums and I will explain the P&L on the current premiums. And when in the actual situation, we cannot determine the premium now, right? Means the actual situations based on the IV, based on the market movement, magnitude, this premium will differ, okay? So we cannot determine that. So right now, whatever is available as a premium, I will just explain for you, okay? So you consider that this goes to 50 rupees, okay? I will say 50. So when you go and buy that for a 50 rupees, your loss is limited to only about 5,000 rupees at expiry. If the market is breaching your break even and expiring there, market can go anywhere, does not matter. Even it goes to 17,000 by expiry, your loss is limited only to 4,953 rupees only. You can see here it is 4,953 is here. You can see that. Okay. This is adjustment number 1 on the lower side. Let us see same adjustment number 2, number 1 on the higher side. Let us delete this. Let's say right now the market is at 17,750 and by next week market open, the market shoots up for some other reason, the market shoots up and it breaches 18,000. At 18,000 you are break even. You will find some loss if the market shoots up violently, you will find some loss that time. You can do the adjustment. What we need to do, same thing. We can go and buy a at the money or out of the money put. At the money you can buy, you will pay a little higher premium, or 100 points out of the money you go and buy, you will pay a slightly lower premium. But the important point is you are limiting your loss on the higher side. Okay. So what we do, the market shoots up, so we go and buy 18,100. Right now the premium is 2260, but when it goes there, your premium will be somewhere about 50 rupees depending on what day it goes and how the magnitude of movement is. Okay. So I'll say 50 rupees here. So you go and buy for 50 rupees. On the higher side, your risk is limited to 7,453 or consider 7,500 rupees. Means you are leaving your profit potential. Okay, you are not getting the entire 12,500 rupees whatever was there earlier, because you have paid some money for the hedge here. Same thing on the downside. I did not explain that, but I am explaining it here. Even the market goes to 18,250, 300, 400. Your risk is limited only to 7,500 on the expiry day. Okay. So in this way, this is adjustment number 1. You are hedging your sell position by buying one more option on the same side, on the tested side. Okay. Adjustment number 2. Your original position is here. The adjustment number 2, I am not going to add anything here, but I will give you the adjustment. If the market goes down, your put will be in the money, right? Your call will be out of the money and your put will be in the money. And the put will start gaining in premium and your losses will start on the put side. But your call will be decaying the premium and you will get a good profit on the call side. Now, when it reaches the break even, you are not going to touch the tested side. What is your tested side? It is the put side. Okay, put side we are not going to touch. What we are going to do is we are going to move your call below your put strike. Basically, you are going to invert the straddle. Right now it is a ATM straddle. So when you move only the call side, right now the market you say it comes to 17,500. Okay. So the 17,750 call you are going to move to 17,500. When you do that, what you are doing, you are booking a profit here. This 137 easily would have become 20-25 rupees, because right now the market is at 17,500, right? So 17,750 call will be 250 points out of the money. So the premiums would have already decayed a lot, and based on the time it may be 40 rupees, 30 rupees, 20 rupees, whatever time. If it comes on the expiry day, this will be easily like around 10 rupees only, not more than that. But if it comes on couple of days before expiry, it will be 20 to 30 rupees. Okay. So you will be booking more than 100 rupees here. Here the loss will be there. Here the loss will be huge, loss will be there. 200 rupees loss will be there. It does not matter. What you do, you move this call to 17,500. The 17,500 call will have a premium of somewhere about 100 to 120 rupees, because at the money, right? So that will be 120 rupees. This put would have gained about 200 to 250 rupees. So you are collecting more premium and you are booking the profit in your untested side. So you fixed some profit, then you are going to collect additional premium. By that you are going to increase your break even on the downside. Means right now your break even is 17,500. So when you collect additional premium, that much of break even you will gain here. So if the market reverses a little bit, that is all right. If it reverses a little bit, your call will start giving some trouble. The new call will start giving some trouble, but your put profits will offset your call losses. Okay. So you book the profit and then you move that call to the lower strike than your put. So this will become a inverted straddle. So what we call invert straddle. Okay. Same thing on the call side. If the market shoots up, leave the call as it is, move the put whatever you have got, the 17,750 put, you close this put for a very good profit, about like 80-90 rupees profit you can book here, and then move the call put to 18,000 put, okay, because that is at the money, right? Means you can go and sell the at the money put. There also you will get a very good premium, somewhere close to like 90 to 100 rupees you will get. By collecting that, you are increasing this break even here. So the market is here, your break even will come here. So you are basically collecting. Still the strategy will be unlimited risk only, but the thing is you have already booked the profit and reduced. If the market continues to go up, just see that how much loss you can take as maximum, and you can simply put a stop loss and come out of that position. Okay, means don't try to sell additional call or try to sell additional put and move anything like that. Simply book the profit or minor loss and then you can come out of the position. Okay, this is adjustment number 2. So what is adjustment number 3? The adjustment number 3 will require additional capital from your side. Right now for this straddle you will require about 1,07,000 rupees, right? When the market goes to 18,000, just leave this position as it is and then create one more straddle at 18,000. Selling a 18,000 put and selling a 18,000 call and probably collecting another 200 rupees there. Okay. So when you collect another 200 rupees, your break even will increase by at least another 150, because you will be having some loss here. So at least by another 100 rupees, 125 rupees it will increase. So that will provide you a cushion. Still your maximum loss or maximum profit is undefined, but you have already got the break even widened a bit so that you can still continue to be in the trade. But for doing this adjustment, you will require additional capital of another 1 lakh to 1.5 lakhs. You will require additional capital. Same on the lower side also. If it comes down to 17,500, you create another straddle at 17,500 and you can increase your break even here. You will be reducing your break even here, does not matter, because this one is already out of the money. If the market reverses, your initial straddle will give you a good profit. Your current straddle may provide a loss, but your initial straddle will provide a very good profit. At the end, you can come out with a minor profit or a minor loss. Just once you do the adjustment, you fix one stop loss, say 20% of your premium collected. Like consider that you have got 12,500 premium already. Okay. Now by selling a new one, you will collect another 10,000 rupees premium, right? So put everything put together, you are collecting about 22,000 rupees. Just keep 20% as a stop loss. If your loss is going more than 5,000 rupees, simply close the trade and come out. So you are exiting with 5,000 rupees. If the market is consolidating here and there only, your new straddle will provide a very good profit, and even the straddle, your existing straddle will also start decaying and your loss will reduce there. At the end, both put together, you might be in a minor profit also. Simply book the profit and come out. Okay. Since this is a risk undefined strategy, you have to monitor these positions very closely and you can come out with profit without much issue. This can be done because since your premium collected is huge, ATM strikes, right? When you sell ATM strikes, the premium eccentric value what you are collecting is the maximum. So you will collect a huge premium, but there is always a higher risk of market shooting up or market crashing down and breaking your break-even strikes, and it will shoot up and break your upper break even, or it can crash down and break your lower break even. So during that time you have to take a call whether you want to do the adjustment or book a minor loss and come out of the trade. You can choose that. So I have given you 3 adjustment. First adjustment is hedging by buying either a call or put and limiting your losses. That is the first one. The second one is moving the untested side close to the spot and making this as a invert straddle. Second one. Third one is doing a new straddle at ATM. this will require additional capital. So this is the third. So I have given you three adjustments how to manage a straddle. The important point, when to book profit in the straddle. Do not wait for the entire maximum profit to come to you, because market expiring at exactly at 17,750 is having a very less probability. Okay. The market expiring within your profitable range, you have 67% of probability that it will expire within your range. But getting a max profit is very less probability. So the profit booking should happen anywhere between 30 to 50% of your premium as profit. If you are getting 12,500 rupees is your max profit, let's say 12,500 is your max profit, you multiply it by 0.3, so this is 30%. You have to book the profit either at 3,750 rupees or at 50%, 6,250 rupees. If you want to wait out till end of your expiry and you want to make profit, it is at your own risk. What I would suggest is, when you are getting 30 to 50% of your max profit, you can very well book it and come out. This is a weekly income strategy. So weekly, if you are doing in one lot, if you are getting somewhere about 4,000 to 5,000 rupees, it is well and good, right? Don't be very greedy on this, because nobody can predict the market with 100% accuracy. When you are getting a profit of 30 to 50%, no need to do any adjustment. Simply book the profit and come out. You can do one more thing. When you are getting 30 to 50% of the profit, you can make this as an iron fly, because you have already sold ATM call and put, right? Like how we did the first adjustment, either we buy a put or we buy a call based on the break even. So we don't have to wait for the break even. If the market is still at 17,750 after 2 days, it did not move anywhere and the premium have decayed and you have got 30-40% of profit, you can choose either one. You can book the profit, you can come out of the trade, or you can simply do the hedging on both the sides. This strategy will become a iron fly. So your loss is defined on both the sides. Your profit will reduce a little bit, but your loss will be defined on both the sides and you can come out of the trade. I hope you understood the short straddle strategy, how the payoff will look like, and in which script to do this one. I am suggesting only Nifty. Don't do it in Bank Nifty. Don't do it on stocks. Bank Nifty you can do intraday. As I explained, 920 straddle is very popular in Bank Nifty, but that is a intraday trade. It is not a positional trade. Bank Nifty is very volatile. You have to do lot of adjustments and you have to keep on monitoring the position. If you can do that, you can do it in Bank Nifty. But since most of the people who are watching my videos or contacting me, they are full-time working somewhere and they are doing only part-time the stock market. Do not take any risk with Bank Nifty or stocks. Stocks can become illiquid towards the expiry. When it becomes ITM, it is very difficult to close the position, and adding to that, the stock can go anytime into a F&O ban. Indices will not go, never go into F&O ban, but stocks will go into F&O ban. When it goes into the F&O ban and if your position is in trouble, you cannot do any adjustment. You have to simply exit the trade with whatever profit or loss is there on the table. Okay, means you cannot do any adjustment, cannot buy options or sell additional option, cannot do anything, not allowed. You have to simply close your existing position and come out. So those risks are also there on the stock options. So do it in Nifty, make money, book your profit at 30 to 50% of your max profit and come out, or make this as a iron fly. Your margin will also reduce because you are already hedging your position. Your margin requirement will also reduce. You can hold this one till expiry. Is possible to hold this one if you do it in indices. If you are doing in stock, holding till expiry is not possible because you should have cash to accommodate for the physical settlement, because physical settlement means one F&O lot equivalent of shares you have to either take delivery or give delivery. So for that amount you have to keep the percentage of amount every day in your trading account. In India, the F&O lot size on an average for a stock it is about 5 to 6 lakhs. Okay, for some stocks it may be 12 lakh, 13 lakh, but most of the stocks it is somewhere about 5 to 6 lakhs, sometimes 8 lakhs. 5 to 8 lakhs you can consider. So 5 to 8 lakhs money you have to keep in your account apart from whatever margin you have paid for the trade. So it is very difficult to keep that amount idle in the trading account. Okay, so don't work on the stock options, don't do positional in bank nifty, just do it in nifty and make money at 30 to 50% of your max profit. If you get at any day, simply book the profit and come out. Okay, so that's all for the strategy. Now this is a very popular strategy, short straddle. I hope you understood the strategy. Thank you for being with me. Signing off, this is JR. May the markets be with you. Thank you. Bye bye. Thanks for watching. If you like our content, please subscribe to our channel, like and share the video. Thank you.